The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Really good to see you, everybody, this morning. It's Monday and you're watching Scorebox. I'm Steve Sedgwick and these are your headlines. President Trump threatening 25% tariffs on all steel and aluminium imports, adding a new front to his trade wars and promising further reciprocal levies in the coming days. Chinese retaliatory tariffs on around $14 billion worth of US goods take effect, whilst fresh data shows a pickup in consumer inflation in the world's second largest economy. The German Chancellor Olaf Scholz and election frontrunner Friedrich Merz go head-to-head in the first television debate, with the health of Europe's largest economy dominating the conversation.
I'm shocked at how you're interpreting the situation. We are now in the third year of a recession. This has never happened in Germany before.
We are better than others when it comes to exports. That's why we also feel to a greater extent what's happening in the global economy.
Plus, pressure mounting on BP as activist investor Elliot Management reportedly builds a stake in the British energy producer.
And French President Emmanuel Macron pledges more than 100 billion euros worth of AI investment as top names in the public and private sector descend on Paris for the AI Action Summit.
So, President Trump says he will impose a 25% tariff on all steel and aluminium imports today. That's on top of existing duties. Now, speaking to reporters on board Air Force One, Mr. Trump also said he would announce new tariffs on countries which restrict U.S. exports. I wonder what your definition is of restricting U.S. exports. Anyway, with details expected Tuesday or Wednesday.
It won't affect everybody because there's somewhere we have similar tariffs. But the ones that are taking advantage of the United States, we're going to have it's reciprocity, it's reciprocal.
Did you see did you spot the obvious thing in there? It's like if you were kind of, well, what was, just show the pictures. Don't need the sound. Can you spot anything, everybody? Look at the left-hand side. Erica. Yeah? You know what that picture says, don't you? Yeah, have you all spotted it? They've changed the map, haven't they? That's Gulf of America. Remember, when was it? When was it Gulf of Mexico? Oh, yeah, for most of my life. In fact, all of my life. Anyway, that said Erica for America, Gulf of. You've got to spot the subtleties with Mr. Trump, haven't you, as well as the blunt force. Anyway, China, meanwhile, has imposed its planned retaliatory tariffs on US imports, with levies of 10 to 15% on goods including imported oil, natural gas, and some automotive products. Beijing announced the curbs last week in response to President Trump's decision to impose a 10% tariff on Chinese imports. Well, Chinese CPI, meanwhile, rose at its fastest pace in 5 months in January. Prices rising 0.5% on the year. Now, that's slightly ahead of the economists' expectations and up from 0.1% in December, boosted by consumer spending through the Lunar New Year holiday. Let's get to Fred Neumann, who is Chief Asia Economist at HSBC. Fred, always good to see you. I'm sure you spotted that it was changed to the Gulf of America rather than Mexico, but that's not what I need us to talk about. I'll tell you what, let's get out of the way, first of all, that China inflation story. Now, seeing a sign of inflation is normally a positive thing, but is it positive in this case, or are there negative influences?
Well, a bit of a bump here around the Chinese New Year, perhaps in the run-up to that, a bit more consumer spending, but 0.5% inflation doesn't mean China's out of the woods yet when it comes to the disinflationary pressure we've seen. So we need to see much more consumer spending on a sustained basis to get ourselves out of this declining price rut. And so it's probably a number that you probably want to put in the back of the shelf and wait for more evidence that was really emerged from the disinflationary phase that we had over the last couple of years or so.
Okay, Fred, let's move on to this issue, which isn't going away. It's going to get bigger and bigger. The Chinese as they promised, have retaliated against Donald Trump and imposed tariffs on $14 billion of US goods. It is a calibrated move. They haven't gone and stepped up the aggression, but actually it does tell the story that these negotiations between Xi and Trump, they haven't happened. Why do you think they haven't happened?
Well, it's in part because the Chinese are probably want to play a little bit for time here. They're saying, look, we can probably take a 10% tariff for now, but let's keep the door open to maybe a bit more discussion with Mr. Trump. There might be potentially a visit by the U.S. president to China. There's plenty more we could discuss. There's maybe reviving the old phase one trade deal. So the first reaction is probably to say, you know what, we're going to impose some tariffs, but we're not going to go all out just to keep the door open. But the more comes from the White House, the more the Chinese are also going to be willing to counteract these moves. In fact, some of the things that they announced last week is really clearly flexing the muscle and saying, hey, we could do much more here if there's more tariffs to come from the other side.
Fred, I'm going to ask you an impossible question, but I still wonder what you thought. Do you think this is going to ratchet up and up and up? Or actually, do you think we could find some agreements on rapprochement trans-Pacific?
You're asking me to predict exactly what's coming out of the White House in the next few weeks. I don't think anybody is quite sure about that. But I think the risk must lie really towards an intensification of the trade tensions in the very near term. I wouldn't rule out a deal by any stretch of imagination. We had it in the first Trump administration as well. But it's going to take a while to get there because in part, the Chinese are not going to turn around and just give over the store. They want to have a negotiation. They want to see what's in there for them. And so it's not going to be a very easy walk, I think, to come to a big agreement. And so we're going to look at many more months of intensification before we ever get to that deal.
Yeah, and I hear you, Fred, about the unpredictability, because we don't know if this is about trade imbalances, whether it's about protection of your industries on both sides of the Pacific as well, whether it's the race for AI, or actually whether it's about something like fentanyl as well. There are so many fronts that this could be about compared with what traditional trade wars appear to be about as well. Do you think actually there's some low-hanging fruit, though, actually, that they can agree on?
There is some stuff. I think fentanyl is, for example, one area where the Chinese could clearly signal we're doing X, Y, and Z, something that the Canadians have done, and that will give them Mr. Trump something to turn around and say, look, at least we've gotten this, and now I'm going to maybe suspend the 10%. But that would be just one flavor, one aspect of this. And as you rightly say, there are many, many motivations for imposing tariffs. And so we would only check the box on one of these motives. We still have other issues to deal with, including the bilateral deficit, for example, issues over corporate access, corporation access to the Chinese market or to the U.S. So technology restrictions, for example, there's so much in there that it will take some time to wrap it up all into a neat little package. I think that's going to take very, very skilled negotiators to get all these aspects into one big deal.
Fred, we had another guest on last week, and for my sins, I'm actually now listening to his book as I drive in every day and drive out of London as well. And it's all about what American companies can and can't do in China, and where there are going to be barriers, it's going to be very difficult, and where actually there are amazing opportunities still in China. Just for our viewers as well, where do you think actually the most underrated opportunities are for the international investor are in China at the moment?
Well, look, tech is one area. If you just look at the tech sector development, I mean, DeepSeek, everybody talks about that, but many more such applications on development in China. We saw very good performance actually by tech stocks out of China listed in Hong Kong, by some measures even outperforming the Magnificent Seven in the US over the past year. So there's a lot of dynamism still in China's economy. I think tech is something that investors just threw away and said, oh, the Chinese are going to compete against the US. And now we're finding actually there are very good Chinese companies who can make the road, can kind of make a breakthrough as well. So tech be one area, but then there's a lot other things. There's many American companies still making good bucks in China. If you take Tesla, for example, Elon Musk's company himself, big exposure to Chinese market. So it's not clear to us that really all U.S. companies are willing to sign off the Chinese market. There is a lot to explore. It will be one of the fastest growing markets in the world. And so even with the current economic headwinds, it remains the second largest economy in the world with plenty of opportunities.
Yeah, so as we say, a lot of it depends on that relationship across the Pacific as well. But Fred, the Chinese consumer, if they can get that motoring, and it's something you and I have discussed for at least a couple of years on this one as well, if they can get the Chinese consumer feeling more confident about their job, more confident about social safety nets, more confident about their investments, then that is the gold mine. That is the secret sauce for the Politburo in Beijing as well. Where are we at on getting the consumer feeling confident and ergo spending more money again?
We're not quite there yet, but you know what? We're watching really closely the property market because that must be one of the things that ultimately helps revive confidence. Once the consumers see property values stop falling, once you get some sense of property stabilizing, that will do a lot to financial confidence in China. And there are some sprinkles here the last 4 months whereby we could argue that Chinese property has begun to bottom out, just the beginning of this. Now, I'm not arguing for a quick fix here, but going into 26, for example, going to 27, once you take the brakes of a property, there's a stabilization there. There's a lot of money on the sidelines in China, a lot of savings there, and are redeployed, and that will lead to consumption picking up.
Fred, let me park China there for the moment. I know that's what you were booked to talk about, but you are the chief Asia rather than chief China economist over at HSBC. And I just want to just go back, if I can, to the broader antagonism from Donald Trump towards a lot of trading partners as well. I'm sure you're asked this question by your clients and colleagues as well. Is there anywhere else that we need to look, that our viewers need to look at more forensically about the threat of Trump tariffs and Trump foreign policy rather than just China? We laser focus onto China, of course, naturally. But is there anywhere else that we're underestimating the risks?
We are in a number of economies. In fact, China's economy is not as exposed to the U.S. Compared to many of the other Asian economies. Korea, Japan, Vietnam, for example, Malaysia, Taiwan's economy, all of major exposure to the U.S. Thailand even has a bigger exposure to the U.S. market relative to these GDP than China does. So any tariff on these economies would hit that much harder. And we don't know where the next focus is going to be by the White House. During the Trump 1 administration, we knew it was primarily China. Other economies in Asia benefited, particularly ASEAN. But if we now get a focus on the ASEAN economies, well, then we have issues here as well. So you're probably better off in economies like India, the Philippines, Indonesia, that really aren't as trade reliant. And so they're the ones where you could argue, say, we're a bit more insulated from all the topsy-turviness around tariffs that's going on currently.
This is extraordinary because in Trump Mark 1, in Trump 45, American companies, a lot of international companies, specifically and deliberately chose those countries that you just mentioned, the Vietnams of this world, the Thailands of this world, because they thought it would insulate them against the angst between Beijing and DC. They specifically thought, OK, we will near shore in terms of allies. We will friend shore as well. And so that is extraordinary. And what a pivot as well for the thinking they're going to need to have as well, that actually there is nowhere close to America in terms of politics, in terms of thinking, in terms of liberal democracy, that's going to be easier for those countries to negotiate the Trump presidency. Actually, they just need to bring all that production home, or actually it's still going to be problematic.
Exactly. It's precisely the uncertainty around this that will already generate headwinds for growth, because it means that companies will start to reevaluate their investment decisions across the board. So even if we don't have immediate tariffs coming in on Mexico or Southeast Asia, you're still going to see multinational companies think twice about the cross-border investment. And that in itself has a growth impact. So uncertainty matters enormously here. And as long as we're in a period of uncertainty, that's going to be a headwind for growth.
Fred, we've covered a lot of ground. Lovely to see you, sir. Our lives are not going to be dull, that's for sure, over the next couple of years. Thank you, sir. Fred Neumann, who is Chief Asia Economist at HSBC. Now, I specifically asked a CEO in the last 2 weeks whether he felt his job was under pressure, whether actually there were moves afoot to replace him. That CEO was Pekka Lundmark, and he was the CEO, or is just about still the CEO, of Nokia. You can see the share price performance over Nokia, despite his confidence that actually what was going on in terms of the search was for a successor over the medium term, well, that appears not to have been the case. The search for a successor over at Nokia appears to be on the short term. With that in mind, Finland's Nokia has said today that its CEO Pekka Lundmark is going to step down and Justin Hotard will take over the role. The latter gentleman will take up the role from April 1st. That is an extraordinarily tight time frame as well, and way tighter than implied by the answer to my question from Pekka Lundmark. What I'm doing now is I'm searching out the tape so we can give you that specific Q&A that I had with Pekka Lundmark literally just a couple of weeks ago. So Mr. Hotard, I wasn't aware, I don't know if you were as well, currently leads the data center and AI group over at Intel. According to the Nokia chair, Mr. Baldorf, they say that Justin Hotard has a strong track record of accelerating growth in technology companies along with vast experience in AI and data center markets, which are critical for Nokia's future as well. So the medium-term search for a successor over at Nokia, which was first flagged up by a lot of the press in the industry late last year, has taken a very swift turn as well. And that's very fascinating for all of us as well. Right, I am delighted to say the magnificent Sylvia Maro has joined me on Squawk Box and is going to look at the markets. Lovely to see you, Sylvia.
Lovely to see you too, Steve. Good morning. I mean, the 1 week was last week in the markets. From economic data to tariffs, it was a volatile one for markets. So let me recap what happened so you can get started for this new trading week. Looking at US markets, we had the three major indices ending the week lower. Look at those numbers, in particular for the Nasdaq, they ended the week down almost 1.4%. However, I want to put things into perspective here. Thinking about their week-to-date performance, the Nasdaq was only down about 0.5%. However, though, when you think about all that's going on, I also have to take you to the bond market. Let's get a check on what's been happening there, because no doubt the non-farm payroll figure on Friday also drove a lot of the market momentum last week. At this stage, though, thinking about the yield on the 10-year paper, we are tracking lower at 4.485. That's lower from the close that we had on Friday. However, though, there's new tariff threats on the table as we started this new trading week. So let me show you how that's impacting some of the dollar crosses too. We are seeing further strength for the US dollar. Donald Trump said over the weekend that he would be putting forward new tariffs on steel and aluminium that would affect, quote, everybody. So let's see what he will say later today in that regard. Thinking about the sterling dollar, we are just marginally lower at this stage. Also, when you think about euro against the US dollar, I want to take it to the WTI Brent moves too. So we get a full picture of what's happening across all of the different asset classes. At this stage, we have both WTI and Brent tracking slightly higher. But when you think about their performance on a week-to-date basis, last week both were down more than 2%. So that is the context as you start this new trading week. Gold actually hit a new record last week. At this stage, it's also higher by about 0.8%. How has the Asian session translated thus far? Let's get a check on Asian bourses too. We are seeing green across the board, really, particularly for the Hang Seng. The index is down almost 2% at this stage. We'll discuss that later in the show, but that has a lot to do with investors really looking at AI and tech stocks in China, in particular after the DeepSeek developments. In terms of the opening calls, let me show you how Europe is likely to open later today. They suggest a positive start to the trading day for European bourses. This after we saw the Stoxx 600 ending the week up 0.6%, Steve.
Thank you very much indeed. Lovely to see you. Right, coming up on the show, US job figures surprise to the downside in January's non-farm payrolls report. We'll bring you the details later this hour. Plus, Olaf Scholz and Friedrich Merz clash on everything as you'd expect, really. Trump, debt, NATO. It was their first televised debate as the country's election campaign enters its final fortnight. And we're going to hear from Synthesia CEO and co-founder Victor Ripabelli as the AI Action Summit gets underway in Paris. Don't miss that interview, 7:30 GMT. Tech giants are expected to spend more than $300 billion on AI this year as they race to keep up with demand. Amazon, Google, and Microsoft have all pledged to increase AI spending in the upcoming quarters, targeting growth, especially in their cloud business. Meanwhile, the Meta CEO Mark Zuckerberg said 2025 would be a defining year for AI. The French President Emmanuel Macron has announced 109 billion euros worth of private sector investment into AI over the coming years. Speaking ahead of the AI Action Summit in Paris, Macron said Europe needed to step up its AI spend in order to end its reliance on US and Chinese innovation. Meanwhile, DeepSeek's AI model could be the best work out of China, but the hype is exaggerated. This according to the Google DeepMind CEO Demis Hassabis. Speaking at a Google event in Paris, he said the AI model can do extremely good engineering and change things on a geopolitical scale, but from a technology point of view, did not represent a meaningful change. But it's cheap, and I guess that's the problem for those who are spending a lot more money. Anyway, the AI Action Summit kicks off in Paris today, and Arjun is live on the ground. Looks like you're outside so far, Arjun. I'm very excited to see your coverage at this event. What are you focusing on?
Yeah, I think there's a lot in what you've just sort of read out there, Steve. Geopolitics going to be front and center here. You're going to have representation from the Indian government, from the Chinese government, the US Vice President J.D. Vance also expected to be here as well. And there's an interesting paradox at play here. On the one hand, you're looking at sort of European companies and American companies sort of partnering, but at the same time, the conversation really is very much centered around the US and China and their dominance in AI, with Europe not very much in that conversation. So that more than 100 billion euro investment from President Macron seems to be a sort of gesture to say, look, we shouldn't be kept out of these conversations. We are competitive, we have innovative companies, but we do need to step up that investment. So that's going to be a big part of the conversation here as well. And of course, the big elephant in the room, China. Given the DeepSeek developments, there's going to be a lot of focus on how the Chinese are approaching sort of AI going forward. A large part of this summit is going to be also about collaboration on things like risks, on safety, on regulation. And again, because of the tensions between the likes of the US and China, can they all come to some sort of global consensus here around what AI guardrails and frameworks look like? That's going to be an incredibly difficult task, I think, for all of these nations. So we'll be interested to see if there's any kind of agreements that come out of this. It's come against the backdrop of rising tensions between the two world's biggest tech superpowers, for sure. And that throws an interesting spanner in the works, I think, here. And clearly Europe's going to want to make a lot of noise about its companies and its innovations as well, given what we've seen already out of the likes of the US and China, Steve.
Fabulous coverage. And if our viewers, if we just be quiet for a moment, listen. Can you hear it, everybody? That is the rain on Arjun. So I'm going to let him run inside now. You poor thing. I know those OBs very well, where you're absolutely inundated. You go inside and get a little bit dry, my friend, and we will catch up later. Thank you for the great coverage. Anyway, there's plenty more from Arjun, including on Google's DeepMind CEO. And his comments on AI and what's next for technology. Check out Arjun's article on CNBC.com. And if we listen again, as we go to Sylvia, look, we can't hear any rain because she's lovely and dry. She's not standing outside in Brussels or Paris. How lucky we are, Sylvia.
That's the wonders of being in the studio, for sure. But let me show you something really interesting that's happening in Asian markets today. Let me show you the Hong Seng Index at this stage, because we are actually seeing quite a lot of upside here. You have it on your screen. We are up almost 2% at this stage. And this comes also in relation to what Arjun was reporting from Paris. We are seeing this narrative on AI driving a lot of momentum for particular parts of the market. So let me show you the individual stocks in this case that are tracking quite a lot of attention here, because there's a school of thought suggesting that in the wake of DeepSeek, there's a lot of opportunities, particularly in cheaper and less known tech names over in China. Some of those at this stage are on your screen. However, though, we are seeing also upside for Alibaba, who are quite well known, and Baidu also tracking quite higher at this stage. So let's see how this will unfold over the next couple of hours and indeed over the next couple of days, Steve. But nonetheless, it does highlight how investors are looking at opportunities here and perhaps the next wave of AI AI is no longer in the United States, in those big tech names that some investors consider very expensive at the stage, where AI spending is also quite heavily too, and looking for alternatives elsewhere, particularly in some of those Asian names, Steve.
Yeah, it's very interesting. And I just wonder if we can also tie this into the bigger news flow between China and the US and the onset of tariffs and what have you. I'm thinking actually maybe now a lot of those Chinese tech companies will be beneficiaries of some form of autarky. Autarky is a word that goes back a long while, ladies and gentlemen, which talks about substitution as well. And perhaps the Chinese are thinking, as you quite rightly say, Silvia, they do not need that US technology now if they are moving ahead with domestic models.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.